Today we're looking at the Yahoo Finance page, one of the more interesting free tools available to people who like to invest their money in the stock market and other things. So let's just jump right into it. So here we have it. This is the Yahoo Finance page, finance.yahoo. Now I think I am logged in under my account right here. There it is. I'm Malcolm. Looks slightly different, but all you need to do is sign up if you want it to look more similar to this. But essentially, this is the Yahoo Finance page. I've been using this page, I think, since the early 90s, not early 90s, mid 90s, 97 or right around then is when I started looking at it, and it's actually quite good. It's quite a good resource for people who like to invest their monies, more specifically for the stock market than anything else. They have other resources in here, but this is what I generally do. I have most of my money in the stock market, so I've always used Yahoo Finance as the primary way I do my stock research. Not the only way, but the primary way. And it hasn't changed that much. It looks nicer than it used to, but it hasn't changed that much. There's more news feeds and things like that, but it is a great little tool, and I'm going to walk you through a lot of the different things that they have on it. I don't use this every day. I don't look at my investing tools every day. I don't think it's necessary for most people who are invested in the stock market. Now you can set it up, so I take that kind of back. So I use part of it every day. So on my Yahoo page, the finance information that for my portfolio pops up, and that has a lot of the information that I like to look at. So I do look at that every day, but I don't look at the Yahoo Finance page per se every day. So let's go ahead and take a look. So at the very top underneath here, so if you have your symbols and there's something you're interested in looking for, these are some of the more popular or what they say trending tickets already in there, but you can put your whatever you like, the symbol of the stock you are interested in here. I think that's Apple, right? APL, yeah. So, and then of course brings you to the Apple page. We'll look at that a little bit later. But mutual funds are in there. A lot of mutual funds, not all of them. What are they called? I've actually never searched for news in here, but I'm assuming it just uses the what do they call it? Search engine to just find probably finance related news first, but not necessarily, I suppose. But right below that, of course, this is the finance home. So you've got your little bar here, and this is what it comes back to. These are things that I have a watch list, my portfolio, and you've got different markets, things like that. Screeners, personal finance. I rarely use the screeners. I mean, I think most people don't need to do that. But of course, I believe ETFs is what I was thinking of earlier. Sorry. You can type your ETF in here to get the, information. Their information page, and your QQQ, probably one of the biggest ones out there. But anyways, so that's what these are. That's what that can do. And these are just different things. Like I said, screeners, personal finance. So once again, something I rarely look at. They have a lot of high yield, on banking information, checking accounts where you can shop around to get better deals on CDs and things like that. Which, if you're interested in those things, it's there. They have that available. But for the most part, historically, I've only used this to do stock research, and it's got some interesting things for that. But before we do that, let's go ahead and look at this. So right here we have some what do they call this? this anyways, these are almost like tickers, but they're not tickers, obviously. But you can go left and right. Well, you can go along here, and it gives you some, generally, these are the things that the news kind of reports on all the time. So you have the S&P. Well, right now, because of the time of the day, it's 2:46 in the morning. They actually have the futures markets up. And, I think it's when we get around 3:30, you have where they have it against the where they do like the prediction for it, where they predict what, if the market is going to be up or down based upon the going rate of the futures. So there we go. We have so right now, as you can see, they are marginally expected to be up for tomorrow. So 0.5%, whatever. So there hasn't been that much news. But if something happens and the markets are closed, this is where you can find the information in general about what's expected the market to do. Now, once the market's open, the futures go away and you have the actual, what's going on in the actual one. And I don't think this is real time. It might be real time, but used to be of 15-minute delay. It might be real time now. It's really not that important. It shouldn't matter that much to you if you are not an active investor. If you get the round numbers, you should be fine. But here we got the SP 500, the 500 largest U.S. companies, basically. The Dow futures, Dow Industrial Average, which is essentially 30 companies picked by the Dow company, the Dow reporting group. And essentially that's just their belief of what 30, I wouldn't say largest companies, but 30 companies that kind of are very large, that make up a large base of the United States economy, or at least represents a large base of the United States economy. It's not the S&P 500, of course. 500 companies versus 30 is generally used more as a comparison or a substitute for the U.S. economy. Then you have the NASDAQ futures, and essentially I think this is essentially the NASDAQ 100, which is the top 100 companies. And the NASDAQ 100, from my recollection, is besides being the top 100 companies, it is weighted by market cap. So the companies that are the largest, your Apples, your Google, those companies will have a much greater weight on the average than, the 100th company. So, and then you have the Russell 2000, which is, the 2000 largest companies. I don't believe that excludes the 500, but it could just be the smallest. Beyond the 500, that's 2,000. But, it just includes a lot of other companies. And I don't believe that one is necessarily weighted. But I'm going to have a podcast specifically about these indexes in the near future. But this is where the information is available. It pops up. And if we click the little button there, we have crude oil comes up. And of course, this is the crude oil futures, how much crude oil is going for at the moment by the barrel. You can always click the thing to show you at least today's history. And if you want to go back, you can look at the 5-year history, and we can expand upon that even further. And then you have to go back. You have gold, and everyone knows what gold is, hopefully, and silver. I really don't know why they include silver anymore. It's not really that big a deal. And then we go on to euro versus dollars. So this is kind of weird. it says euro basically divided by US dollars, but it's actually the other way around. So you need $1.09 to get 1 euro. So, and you go further on, and you got the 10-year bond. That's the 10-year Treasury bond. That's the what the United States government is getting from people who are giving. For people who lend them money. That's 4.146%. The VIX index is supposed to be a measure of the volatility. I don't know if that's even a real thing. In that it has any real meaning. It might be measuring, things that are in the past, but once again, we'll go into those a little bit deeper in the future. And then next we have US dollars per British pound, and right now you need $1.27 approximately to get 1 British pound. Japanese yen, and like I said, they flipped this over, so you need 148 Japanese yen for each dollar. And we got Bitcoin. I think most people know what that is. Up to 40,000. Wow, that's interesting. I didn't realize it had gone up that much. Let's look at the year to date. I just want to take a quick look. It's at 42, and it's actually down. Wow, I haven't been following it that closely. And see, we can see that it's quite the ride. Last time I was looking at Bitcoin, I think it was around 34. So, yeah, it hasn't been that long. October. Oh, I typed on it year to date. It's only January, so I'm like, wow, it's had a nice move. It's had a nice move since the beginning of the year. So let's go back here. We'll check out a few more things. What else is on here? You have the FTSE 100, which is the Financial Times stock. Basically, what the top 100, I think, companies in London are doing. The CMC Crypto 200. I'm assuming I really don't know what that is. I'm assuming it's the top 200 cryptocurrencies out there. And finally, the Nikkei. The Nikkei is the Japanese stock market. Essentially, since it says the 225, I'm assuming it's the 225 largest Japanese companies trading on the Nikkei. So there you go. This is some basic stuff that goes in here. Now, if we go down a little bit further, if we go down a little bit further, we have news, and you can go through and read whatever you're interested in. For the most part, I find most of the news stories to be, wanting, and it's just not Yahoo News. It's just in general, especially when it comes to stocks. I've just found I think you need to read into everything to pull anything out of real value. There's a few things out there, a few companies, Wall Street Journal, that add some actual value to it. But it's like just reading the headlines. It's traders won't get fooled again. It's just it's just kind of clickbaity. So take it for what it is. Do you want to read some of these articles? It probably makes sense to just to get a feel for what's out there, what kind of information is being passed along. But to actually use it to directly invest, probably not. But that's what's obviously down this middle aisle. They have personal finance as well, and you'll have, when there's movements, the guest best of someone, they'll put there why the market moved up or moved down. It's just people like to read that. It's not necessarily true. Don't ever read anything, especially financial news, and believe that this person is speaking the truth. They might be being honest. This may be their opinion, but certainly for someone to summarize what's going on in the stock market and why it's moving up or down, in general, they are going to be, we'll say wrong. But, wrong might be going too far. It might just won't be complete. The answer won't be complete. So there you go. So on the right, these are a lot of the things that I've looked up in the past, different stocks, has some of my portfolios in there, different things I've been invested in over time. And, that's basically it. Like I said, there's a wealth of information within Yahoo Finance. This is just the homepage, and even within just the homepage, there's information that's valuable. It's interesting. I don't think it has my portfolio information directly in here, which is kind of interesting. But okay, that's fine. But it is on my Yahoo page, and it shows what stocks I'm invested in and how they're doing, and that's nice. That's nice to see. And and then just like this, if you see something spikes your interest, you click on it, and now you have some important information. So here we go. Now, this is one of the things that as an investor you probably want to be invested in, and this is the SPY. Now, the SPY comes in a lot of forms. I believe SPY is one of the original ETFs, short for spider funds, but there are a lot of what they call clones. So what they figured out years ago was that for the most part, people aren't good. Even experts are not good at picking stocks. So they found that essentially, picking stocks better than average. It's hard to distinguish someone who is very good at picking stocks from someone who is not very good at picking stocks, so, investment-wise. And look, there's a lot of reasons for that. So the advent of the ETF was designed essentially to lower the costs. And if you were investing 30 years ago, as I was, that 2%, 3%, 4% was not unusual. They weren't unusual expenses per year. That was quite common. So, you can look here. Look at this expense ratio, 0.09%. Think about that. We've gone from, 1% was like good. We're down to 0.09%. Why that matters is because that's money that you are not paying, right? That's money that you are making over time that you once didn't. And like I said, it was not that long ago. 20, 30 years ago, 4% was, they used to have loads, and you'd have to, front end loads, back end loads. It was crazy. And a lot of that stuff was to pay the salesperson, and but it was what it was. But now we have mostly ETFs. There's still tons of mutual funds out there, but not all mutual funds are going to be available on here, especially ones that are in your 401k. You can look for them. You can type them in here. If I were going to start over, I would definitely do that. I would make sure that you have something that you can follow. You can it's there, it's readily available, but something you shouldn't obsess over, but something that you can see, that you are made aware of. Now, it can be very difficult once you start. You have a significant amount of money investing. It can be very easy to be obsessed with it, especially initially when you see these movements that if you're making $200 or $300 a day at your job, but now the stock market is moving up and down $500 a day. Once you have $100,000 invested, you're at that spot. That's kind of the magic spot for, it seems people in the United States when it starts to matter is when you have $100,000 invested. When you have $100,000 invested, now, of course, people are making more than $200-300 a day now. But for years, that was kind of like the number. Somebody got that and they started watching. They'd be like, oh, I made more money in the stock market today than I did at work. Okay. So, and of course, as that number increases, the interest generally increases. But I can tell you this, once it gets to a certain amount, I think you realize, maybe it requires a little bit of education as well, that you don't need to be staring at it. It's going to go up or down whether you're looking at it or not. And, you're not necessarily, you can be using that time to be more productive. Right? And that's what this channel is all about, being more productive. And that's why I'm going over this. I'm hoping that, for those individuals out there, hopefully, that want to be more productive in your life and you want to get more out of life, well, one of the tools that you can use is investments, specifically financial investments in things like the stock market, things like bonds, CDs, and things like that. And we'll go over that more, but right now we're just looking at Yahoo Finance and some of the tools it has available. So I want to go over quickly. As you can see, this is an ETF. This tells you what the expense ratio is. It doesn't tell you necessarily what the I don't see like a beta in here. Do you see a beta? There it is, beta. So the beta, and this is fortuitous, I suppose. The beta of 1 is supposed to be where the entire market is. So this is kind of a cheat right here, right? This says 1. Well, it says 1 because this is what's used as the default beta of 1. So yes, it's a cheat. This is a default beta of 1 because this is what we use. We use this number. You use the S&P 500. Now, you don't necessarily need to do that, but I'm assuming that's what Yahoo has chosen, the S&P 500, and specifically the SPY, because usually there can be, maybe because of rounding, this shouldn't be a perfect 1. Like nothing except the entire world of investing put together would be a 1. And this certainly doesn't represent that. But it is close enough for, our equations that this is what we use. And we'll get to that in the future as well. We'll start doing some calculations. We'll go through some basic calculations and how to use this number. This number is important too. We talked about that briefly. Let's go there. So if you don't know what the bid and the ask are, that's basically if you want to buy and you want to sell, right? If you want to buy something, now as you can see, you can't see what the actual bid and ask are because the market is closed. But right now 483. If you wanted to, so here I go, 483. If you wanted to, buy it, if you wanted to sell it, this is what you're looking at. This number on the right is the number of shares. Your day's range, this was yesterday's information. As you can see, it's going to open up higher, it looks like. But based on yesterday, this is what it was. Traded between 476.54 and 482.71. And this isn't necessarily true in that there are trades that are done outside of the stock market. So there could be some trades that occurred that were higher, trades that occurred that were lower. As you start trading, whether it's on, if you should happen to do individual stocks or even ETFs, a lot of the trades don't actually go through this number. Where is this magic number? The volume. It doesn't necessarily represent everything. And, to my knowledge, this might represent very little at this point. 110 million shares. Because, whoever your broker is, they are using the shares within the brokerage to buy and sell. So, they're going to have, other clients who have your asset, who have the stock, and they're going to use those to make what they call make a market in that particular stock. A lot of them will do that. And that's just how they make money. They make extra money because there's going to be a difference between this bid and ask, and that's free money. Free money to the market makers, right? Free is probably a bad word, but they're getting that money per transaction. So they just need to make sure, that things are kind of balancing out. And within they might have a large enough market that, one of their clients in New York is buying and one of them in LA is selling. Or maybe they could be literally in the same building. One's buying, one's selling, but they're making a market through the same brokerage, and the brokerage company keeps that difference between the bid and the ask. So, perfectly legitimate business practice, but that's what it is. So, anyways, we'll go on. 52-week range, I think we talked about that. That's what's going on over the last 52 weeks. So for some people, as you can see, you may have figured out 482.72. So we're pretty much going to be trading at a new 52-week high. I'm sure that's not an all-time high. And if you want to click on that, we can look at that real fast. The all-time high, well, maybe it is. Well, let's see. Yep. I didn't realize we were all-time high for, it says 474.96. Yeah, it looks like we were at an all-time high. I didn't realize we had hit all-time high yesterday. So, and we're going to hit an all-time high when the market opens. So what else do we have here? Average volume, that just tells you it was a little bit heavier day than normal. And that's actually a little bit important. When there's a lot of activity, you can, it might make you feel as though, it makes me feel that, it was at least an average day or above average day as far as people being involved in the market. So the price is a little more real, I guess. So when you're trying to buy and sell, if, during holiday times and things like that, volume drops. So the people who are doing this may not be there. So the prices may be a little more on the extreme side. It's not as competitive. We'll use that word, competitive. So is it true or not? I haven't, in my experience, yes, but I haven't done any kind of scientific research to make sure that's the case. Next, net assets, whatever, 497 billion. That should be the total amount that the fund holds, 497 billion, which is a lot, right? You talk about $500 billion, but relatively speaking, my guess is if you look at all of the different S&P variants, you're talking trillions and trillions of dollars. Net asset value, that's just basically 482 to 482, right? There shouldn't be that much different because of how much this is traded. Now, you might see this being different, and there's different reasons for that. One of those things being taxes. One of those things being how well traded the assets are within the fund, right? If things aren't being traded that often, transaction costs start building. Like the difference between the bid and the ask here, I'm going to say it's probably less than a penny. Might be a penny. You say, a penny, who cares about a penny? Well, a penny times 110 million shares a day is $1 million. right? It's $1 million in earnings that the market makers have in this stock, or ETF, as it's called. So yeah, it's, so it might be more, but it shouldn't be that much more. But when a stock or ETF is not heavily traded, then you're going to see what we call the spread. The difference between the bid and ask is going to be greater. Next, the price to earnings ratio. This is an important number because this tells you, generally speaking, what the current price is versus the earnings. Now, PE ratios, certainly earnings can be manipulated to a certain degree, but in the long run, earnings have always been the key driver of value in the stock market. But yes, companies can play games with their earnings, and at least in the short run. But this number 24.3, one thing that I've looked at, traditionally speaking, is is that a high number or a low number? Now, just because 24.3 is a little bit of a high number in historical terms. With that being said, when you think about it, we've had a kind of a down period. So if people believe earnings are going to accelerate, and this happens after a down period, right? So you have a down period of earnings, but now when you're investing in the stock market, you're looking forward. Yes, things right now might be garbage, but if you can see that things are getting better, then you'd expect earnings to get better. And if earnings are going to get better, then overall the stock market is going to go up. So, this number in itself is kind of a warning number, but depending on whether you've been going down or you've been going up, how this market has been, we'll talk about this, ways to look at this. It matters. So, something you might want to follow is the PE ratio of something like the S&P 500, which we use as the placeholder for the economy. So, and this is the yield. Generally speaking, they would put dividend yield. So this is how much you would earn if you had $100 invested in the S&P 500. You'd make $1.40 a year. Usually this is a yearly number. And now they have year-to-date daily total return. 1.5 sounds terrible, but of course the year just started. This is a kind of a year-to-date daily total return. That's kind of a new one for me. It doesn't make much sense to me, 1.5%. So I'm assuming that the market is up 1.5%. I have a hard time believing that it's been up 1.5% every day. But here we go. Let's go year to date. 482. Does it give me a percent? Doesn't give me a percent, but 471. 10. It's definitely not 1% a day. We are 19 days in. Even if it was just we're not up 1.5%. So, but 1% of 482, 6%, 1.5%. So we $6. Is that? Yeah, I mean it's close to that. So yeah, I'm not necessarily sure what they mean by this number. Maybe because there's no dividend payouts yet. Okay, and this of course tells you the date that the fund was started, 1993. So quite some time ago. Now they used to use S&P 500. They didn't use the spider. I don't know when they transitioned away from it, but it was just the the S&P 500 for a long time. So, I mean, those are the basics of, in this case, an ETF, but I want to go through a stock. And let's do one of the largest companies in the world, Apple. Now, you have to, sometimes you need to make sure that if you're interested in a company, they don't have, 10 different, of course, being able to spell Apple is, they don't have a bunch of different, what do they call it, different types of stocks. Like Google has a few different types of stocks, because that's going to affect your valuations. And this is just kind of quick and dirty. And what I'm going to give you is just what I used when I was investing in stocks. I don't have actually any money in only stocks at the moment. I have it mostly in ETFs for whatever reason. We'll talk about that and some of the choices you're going to have to make as an investor going forward if that's something you're interested in doing. But here's Apple. It's this is the symbol, AAPL. If you watch CNBC or Bloomberg News or any of those things, when it comes across, it'll come across as AAPL, and it usually shows you the price and whether it's up or down on the tickers. But this is the basic information as we went through with the ETF. This was the previous close and what it opened at. So Apple was, that's really weird. Why does it say open and close? Maybe this is the previous day's information. So 2 days ago it was at 188, and then yesterday it opened at 189 and closed at 191, which is $2.93. It's up from the previous close and up 1.55%, which is if you think about it, it's a pretty big move. And the market cap is over here, 2.96 trillion. I didn't realize it was up that high. A lot of news concerning Apple's visor, Apple Vision, something like that. But anyway, so those are the same thing. The bid and ask, as we talked about before the market's closed. So right now, those numbers aren't there. Day's range, that was obviously yesterday's, and it looks like it. See, here we go. 191.56 was the day's range, and it's not even in the range, right? The closing number. So fascinating, right? So whatever they use here, now that could have been because of the bid-ask spread, things like that. But yeah, it's little. The information is not going to be perfect. So here we go in 52-week range. The high was 199. When was that? Why is it? No, when did I go back to? I went back to 1 day. So we go back to 1 year. Apple was all-time high. But yeah, we can go through and you can look at it. Once again, the volume is 68 million. Average volume is 54. So it's a somewhat heavily traded day. So today is Sunday. I'm sorry. So this is stuff that happened on Friday. The market is closed on Saturdays and Sundays in the United States, and generally opens on Mondays, not for a bunch of holidays. We're back at the market cap. Now this is the beta, and basically the beta is based on the 5-year. It's a calculation, and it's based on the 5-year monthly probably average price of the S&P 500 and Apple in comparison. And based on that, see, before we were looking at S&P 500, it was 1.0. This is 1.29. So this stock, Apple stock, is 29%. I don't want to say riskier, but more volatile. 29% more volatile than the S&P 500. Now that's kind of a a hard thing to be when you're this big, when you're this large part. Now you got to remember, Apple is a part of the S&P 500 as well. So because of that, you're talking about, you're being compared to yourself in a large part, and since you're such a large part of the S&P 500. But to be, 29%, have 29% volatility above and beyond the S&P 500 is actually, I'm a little surprised by that. And when we have the PE ratio, which is higher because, once again, generally the PE ratio should reflect the market's view on how well the company is going to do compared to other companies. Specifically, a company with a higher PE ratio is expected to earn more in the future than a company relative to their stock price, of course, than other companies. So that's what that is. Whether that's true or not is a different story. But that's what, when you are looking at individual stocks, does that make sense? Does it make sense that Apple is, at 31? Do we think it's going to be doing what was the S&P 500 at 22? So do we think it's going to do that much better than the S&P 500? And you have to remember, you got to get compensated for this 0.29. This 29%. You're supposed to be getting compensated for that money, for that additional risk. So make sure that's true also. But we'll talk about it again. We'll talk about that more in the future. Earnings per share is $6.13. So this is where we get price per earnings, right? So we just take the price, $191, divided by the earnings, $6. Guess what? It equals $31.25. Okay. Earnings date. So they tell you essentially the earnings date is, I believe, the 5th. And, you have whatever this, I forget what the January 31st. And I know Apple had a weird fiscal year end at one point. I don't know if that's January 31st or not. Forward dividend. Wow, I didn't know that was, they looked at the forward dividend, but okay, that's kind of new. And so 0.96 is the yearly return from dividends, from the expected return, I should say, from Apple stock. It's not necessarily the case. Dividends, generally speaking, are not guaranteed. Ex-dividend date, November 10th. So that was as of, you needed to own the stock on November 10th to get that dividend, or at least a quarter of that dividend. Generally speaking, dividends are given quarterly. And this 1 year target estimate is $200. Take that for whatever it is. It seems, on the face of it, if you accept this $200, you are not getting much of a return. You're not getting much of a return considering the current value of the U.S. Treasuries. But those are calculations we'll go through if and when I have the time. So those are just basic things. I generally just glance at this stuff and just do the work. I go through and make the calculations myself. I mean, these things here, these are generally based off of, what other companies believe is going to happen with it. But, if you really believe that you're only going to be making $8.40, 44 cents in Apple over the next year, that's not good. Now we're talking a little over 4%. That's not good. That's not a good return when you can guarantee yourself. What was the 10-year? It's up here somewhere, right? You can guarantee yourself 4.1%. And Apple's is certainly not a guarantee. right? That's not guaranteed. So yeah, these are things you need to be compensated on. Okay, so what's next? So what do I do look at? A lot of the times when I'm looking at it, I'm going to be looking at the analysis page. Now this has a lot of information, and these are not things that you're going to be using for your calculations when you are going to do the work of trying to figure out what the company is kind of worth. And so these are the estimates. You know, you have your next year estimates, your current year, and your next year. The next year is obviously what's really important, but the current year can make you feel if is this based in reality. These the expected ones, and revenues, same thing. As you look at the revenues, does it make sense if we're going to grow 5.7%? Well, how does that going to affect our earnings? And then we have the earnings history. So essentially, Apple, for the most part, and this is when we talk about manipulation, right? A company shouldn't be surprising all the time on the upside, right? It should be probably pretty much equal if upside versus downside. But, there's the potential for what they call manipulation. Now, they have things they call the whisper number, things like that, which probably are a little bit more accurate, but they're whispered, so be careful. Anywho, as you can see, we have the earnings per share trend, and you can see like this is the estimate from people who write reports essentially about Apple's potential as an investment. I think there was 33. They have 37 analysts, 33, 25, 38. So they looked at, these different analysts and came up with these numbers, right? And then finally, you have your revisions. So the revisions can come out for various reasons. The company can come out and say, look, you guys are way off. Especially a big company, they're going to have some people looking at this information, and they're going to be trying to provide guidance because they don't want to surprise too much on the upside or downside, especially the downside. They want to, ease people into it, make people feel as though the company knows what's going on with the company. And then finally, you have your growth estimates, and there's some important numbers in here, but the two that I find to be most important are here, your next year, and the next 5 years. Like, where is this company going in the next 5 years? 6.14% growth. That's certainly above the U.S. general GDP, and so that can justify some of the outlook for your why the price to earnings ratio might be too high. But anyways, that's just an aside. I just wanted to go over the information. But that's essentially what I'm looking at. When I'm looking at an individual stock and only the individual information. Now, this information would be nice to have. It's just not in here for whatever reason. Maybe because Apple's just so huge, they just dominate that market. But anyways, that's going to be it for now. In the future, we're going to be going over a lot of this information in more detail. But I wanted just to run through this and hopefully educate you a little bit on one of the great tools that are out here. And as you can see, the futures appear to have gone up a little bit. And happy stock marketing.